Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Matthew Ricciardella. Matthew is the founder of Crystal View Capital, and has over 18 years of experience in the real estate industry. Crystal View Capital is a private equity real estate firm that specializes in acquisition and management of self-storage facilities and manufactured housing communities across the United States. Known for its in-house acquisitions and management team and unique company culture, Crystal View Capital is vertically integrated, disciplined to its investment strategy, and has a proven track record since the firm's launch in 2014. And in just a minute, we're going to speak with Matt about self-storage facilities and manufactured housing. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Matt. Welcome to CRE PN Radio.
Thanks, Darren. Thanks for having me today. I appreciate it.
You bet. I'm looking forward to our talk. Before we get going, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, I'd be happy to. I got started in commercial real estate back in 2005. I started off by buying manufactured housing communities and self-storage facilities for my own account. Started off with relatively little to no capital. So, face that challenge that first-time investors always face, and that's how to raise equity and debt to buy your first deal or your first few deals. So kind of went out to the market, found some off-market opportunities in self-storage and manufactured housing communities, and was able to raise some private capital, put some deals together, and figured out how to manage these assets, created some value, did well. Sold some properties, kept some others, which I still have to this day, which I actually bought back in 2008, that I still operate, and thought that I was onto something. I was doing quite well, but had a limited amount of capital. So what I did is I thought to myself, gosh, wouldn't it be great to scale up? So I launched Crystal View Capital Fund 1 back in 2014. And that was a $10 million equity raise. And we did quite well with that. Actually, investors received back 2.5 times their invested capital, about a 45% internal rate of return. And then we launched Fund 2, same strategy, which was manufactured housing and self-storage across the United States. And that fund is now fully subscribed. We raised a little shy of $60 million in equity on that offering. And we're tracking about a 30% return to our limited partners. And now we've just launched our third fund, Darren, which is a $95 million equity offering. And we've already raised about $38 million in 2.5 months in that fund. Same strategy as Fund 1 and 2. And we're really excited about what the future holds.
Cool. So, in 2005, you had the foresight to get into manufactured housing and self-storage. You're the first. I mean, usually it seems like people have like migrated to that from something like they started out maybe in single family and then felt like something was too competitive or not recognizing other opportunities in real estate. How did you land on manufactured housing and self-storage?
I wish I could tell you, I did a rigorous due diligence and research process, and I did to a small extent, but really a lot of it was luck. I kind of looked at all the different commercial real estate asset classes and thought to myself, which one of these are most inefficiently priced. Which one of these do I have the highest probability to buy at a fair to discounted acquisition price? And where can I create value through inefficient management? And I identified as a result these two property types, and kind of went across the entire country, built relationships with owners, bought most of these deals off market, and it worked out for us. So that's kind of how I got my segue into the space.
So you mentioned you were kind of operating on your own there for a little while before you started the fund. How many parks did you acquire, operate on your own before you decided to go the fund route?
Yeah, I bought personally about four communities personally before we launched the fund, and three storage facilities personally before launching the fund. Um, One community, one mobile home park, and one self storage I still own to this day, both of which were acquired back in 2008 and 2009.
Got it. And were those primarily local acquisitions, or did you
No, the
foreign?
two that I still own today are one's in Wisconsin and the storage facility is in Louisiana.
Gotcha.
So we kind of had a shotgun approach, Darren, where we went across the entire country and said, where am I going to find the best deal? And still do it to this day in that same fashion, in that same manner, where we're kind of agnostic to the market versus saying, hey, we buy this asset class in North Carolina and that's all we do. And if you could show me how I could steal something in some other market, the answer is no, because I boxed myself into this asset class and that market. That's exactly what we didn't want to do. So we're open to looking anywhere for the right opportunity in these two asset classes.
So let me ask you, since 2005, when you first started, till now 2021, what have you seen is the biggest change in that time span as far as uh, I guess the asset class and the opportunity?
Biggest change is there's been a complete 180, and that is, I guess, the analogy I could give you is going from a redheaded stepchild to completely and utterly in vogue. When I started in the industries, capital was extremely hard to come by. It was either seller financing or a local bank. Now you have agencies, Fannie Mae and Freddie Mac, CMBS, life loans, literally knocking at your door, lining up to finance your projects. Same thing on the investment side. Kind of when I got started and told people what I did, they kind of looked at you with a funny face and why in the world would you want to do that? Now you tell people what you do, and it seems like everyone has figured out the secrets out. These are high cash flowing vehicles, cash cows, from what they call them, little risk, recession resilient, and as a result, a large part of the investment community, including institutional investors, have a huge appetite to get into both of these property types.
So in 2005, you described limited capital. Did all of that change kind of post, what do we call it, the big, I don't even know what we call it anymore, the recession, the big, I mean, 2008, with the market when it went upside down. I mean, residential housing was in the tank, foreclosure, short sales, all that fun stuff. Was that kind of the turn where institutional capital recognized the opportunity, or was it later?
Um, I think it was later. You had some institutions that were getting involved post meltdown, let's call it 2012, 13, 14. But I think there was a tidal wave of interest probably that began in 17 and 18, and now it's just tremendous. And I think a lot of it was post COVID because here's in my opinion what happened. If you look across the different four major food groups of commercial real estate, retail, industrial, multifamily, and office. Look at the negative effects that COVID had on hospitality,
Hmm.
office, retail. I mean, just crushing. And those asset types are in distress right now. So I think the smart investors looked at all of the different asset classes and said, which ones withstood the COVID storm? Which ones continue to generate a free cash flow and ongoing income despite the lockdowns and what we went through? And I'll tell you, these two property types are at or near the top of the list. And as a result of that, there's a tremendous amount of demand from sophisticated investors to get into the space because they are recession resilient. They did withstand the 2008, 2009, 10 storm, and now they've proven to be resilient during COVID. So um, folks want yield. They want predictable, safe, free cash flow. And these two asset classes have proven to deliver just that.
So you mentioned the returns that you were able to achieve, with the funds and that. I- As more people migrate into it and want to play in the space, are you seeing that compress returns?
Absolutely. Yeah, cap rates are compressing, yields are compressing. As a result, valuations are expanding and rising. And partly it's because of the increased demand for investors wanting to get into the space. And then also it's the ease of financing. As mentioned, not only is debt capital easy to source, but it's also extremely cheap. I mean, we're getting loans right now, Darren, at sub 3% interest, interest
Wow.
only, fixed for 10 years. I mean, that's extremely attractive debt and it does wonders for your cash flow.
Yeah. No, it is a kind of a funny thing how that really changes the marketplace when money's so available like that. Um, so let me ask you, not totally familiar with, but the mobile home uh, park and kind of the historical stigma, but I've also kind of come to understand that some of the municipalities and that uh, they don't want them. Are you seeing any growth in the market?
Um, Very limited, very limited. There's little to no new development in the space, and that's what makes it appealing and attractive. And in that, you've got limited or shrinking supply because a lot of parks come offline every year. They're converted into, some other use, whether that be retail, and you're not seeing that as much anymore, but could be condos, could be multifamily. No, relatively no new development coming online, but ever increasing demand from renters that want to get into affordable housing. And this is the lowest ring of affordable housing out there. So even cheaper than apartments, Class C apartments. So you're seeing more people downsizing, wanting to get and retiring that want to go into manufactured housing community. And also, if you think about it from a COVID perspective, you're seeing this phenomenon of deurbanization with people leaving these major metropolitan areas and going into secondary and tertiary markets. Well, guess where mobile home communities are relatively located? Exactly in those markets. And guess what else? Compare it to multifamily where you have common areas, or compare it to senior living where you have common areas. You're insulated in your own home, insulated from potential, COVID, contraceptive. So it's helping from that angle as well.
Yeah. No, it seems like the ideal as far as the limited supply and out of control demand. That's where you want to. I mean, if there is a place you want to be, that's I guess a place you want to be a seller, especially. Um,
Absolutely.
so, tell me a little bit about self storage. How does it operate compared to the mobile home parks?
Well, let's talk about supply and demand since we're on that topic. It's not that way in self storage. I wish it were, but it's relatively simple to build storage facilities. Some municipalities aren't allowing it because they're already oversaturated in that marketplace. But a lot of markets out there, you're in Portland. I know your market is oversaturated. Denver, Dallas, Nashville, Tennessee, those markets are oversupplied. So as a result, operators are having to offer concessions, 3 months rent, move-in specials, things of that sort. But there are other markets which we operate in where there is limited supply. And we're able to continually increase our rents, increase our cash flow, and as a result, increase our property valuation. So I think the big thing when you compare these two property types and how they operate differently, the storage, you got to be really cognizant of the supply and the market that you're entering into. From a management side, the operations are very similar. We have an in-house asset management team which manages all of our fund portfolio properties. So we oversee everything in-house here from Las Vegas. So we've developed proprietary systems to manage all of our assets, and there's nuances to each, but we've developed a strategy and a procedure to operate both asset classes effectively.
Do you find that the markets are similar as far as we talked about the metro areas not being uh, or not inviting or wanting the mobile home parks and the oversaturation? Are you finding that the successful markets tend to be more of those tertiary markets for both the mobile home parks and the self storage?
For the storage, yes. For the manufactured housing, if you could own in a major metro and have a large community with good sized lots, that would be my preference.
Right.
As an example, if you could be in Metro Dallas market and have a newer park with larger lots, that's a fantastic market to be in. So, and because there's no new supply. On the storage side, there's plenty of new supply coming to market. So I would say I'd rather be in the major metro markets for manufactured housing, and I'd rather be in the secondary and the tertiary markets for storage. That's not to say that the major markets you won't do well for storage. You just have to know what you're doing. And that's not to say the secondary and tertiary markets won't do well for manufactured housing, because we've proven to do well in all of those different markets between both asset classes.
Right. So you said all of your management, you guys are in house. Is it asset management, or do you do also have in house property management?
Both.
Okay.
We're an in-house asset slash property manager. So we kind of oversee the asset creation, the value creation process from A to Z, all in-house. So that goes from acquiring the property, implementing a value creation plan, executing upon that plan, prepping the asset for sale, and then ultimately exiting at some point in the future.
Gotcha. So with manufactured housing, you don't own the homes necessarily. You own the ground and I guess the streets basically. And what are some value add strategies in that kind of a scenario?
Yeah, so it's a good question. And to reiterate, yes, we own the infrastructure, we own the underlying land. There are some homes in communities that we do own, but for the most part, they're all tenant-owned homes. But there's several, we call them levers to pull to create value. One of them is sometimes we buy a property, rents are materially below market. We simply bring them to a market level. That could create a lot of value. Other times we buy homes, we bring them to vacant sites and sell them, which is increasing our occupancy, increasing the rent roll. Other times we'll identify an expense that's too high, that's bloated. As an example, we'll look at water and sewer expenses, and sometimes the landlord will pay those costs. What we do is we'll submeter, pass that expense through to the residents, and that cost savings falls all to the bottom line. And that increase in NOI is going to have a direct translation when you apply a cap rate to property value.
No, I love all those. Um,
Same here.
fairly easy as opposed to kitchen and bath and capital improvement intensive. That's that's ideal.
Yeah,
Uh,
absolutely. We look for the low hanging fruit. We have a little saying here. We like to step over 1 foot hurdles rather than jump over 7 footers.
yeah, no, I like that. I like that. So, uh, park size. What's an average park size that you guys play in?
For us, the larger the better due to our size. As mentioned in Fund 3, we've raised thus far about $38 million of equity. And we've had no issues with raising equity capital because of our track record and because of how our property types are performing in the market presently. But a park size typically is 150 spaces and larger for us is what we're looking for. And on the self-storage side, it's typically 40,000 square feet and higher.
Gotcha. So let me ask you. So the manufactured housing, uh, is it? Do you consider it affordable housing? Is that essentially I mean, kind of the threshold? Is that kind of where the entry point is? Or
Yeah, not only is it affordable housing, it's the lowest form of affordable housing there is, pretty
okay.
much in every market.
So as the economy goes, I mean, obviously it's been the most resistant asset class as far as um, foreclosures, et cetera. Um, do you have any sense of or concerns, or is there any kind of a forward look or a thought on inflationary concerns? I know, I was watching, I think, Powell the other day talking about, all this money that's been printed and circulated and stuff, and very low concerns about inflation, but there's a lot of wage talk about increasing, minimum wage, blah blah blah. Is there anything in that you look at differently than perhaps somebody that's looking at a multifamily property, or is there any thought to that?
Yeah, I mean, look, I think you bring up a good point with all this printing that's going on. You hear chatter that it's not going to create inflation. I don't see how it's possible to pump trillions of dollars into a system and over the long term not experience inflation. So I think, may not be this year, but at some point within the next 10 years, we've already experienced tremendous inflation of asset values since COVID. I think that trend is going to continue. If you look at the price of a gallon of milk, maybe that hasn't experienced as much inflation, but I think across the board, inflation is going to rise. And I think the benefit for us in what we do is look at our lease terms. Compare what we do to, let's call it retail or office, where you have 5, 10, 15, or 20-year leases, or even last mile distribution facilities, which are leased to Amazon. Those leases are locked in for 10-year leases with, 3% bumps on them. Our leases are month to month or at the most year to year. And what that does, it allows us to readjust for inflation. So we could offset inflationary pressures by increasing our rents accordingly. So we've got a great hedge against inflation due to the timelines or the span of our leases. So that alone is going to be a tremendous benefit for us. Not only that, again, asset values are going to continue to rise. So what's in our portfolio today, if you factor in, let's say, 4 or 5% inflation over the next 10 years, even if we don't increase NOI, think about how much those assets are going to increase in value just as a result of inflation. So
Yeah.
I think we'll do well. I hope we don't get me wrong. I hope this country doesn't enter into a hyperinflationary phase, but if that were to happen, I think we'd be a beneficiary.
Yeah, no, I think there's definitely benefit to having assets as opposed to be sitting in cash if you're experiencing a lot of inflation. So that's definitely true, and it is kind of a weird cycle when you think about just the trillions of dollars that have been put into the market, and I guess it's kind of more of a function of the interest rates, just the availability of the capital that's really cranking the demand and pushing that up. But
Well, I think that is going to be the negative. That's the downside, I think, because rates are going to have to rise to offset this inflation, and now the cost of capital is going to rise. So the borrowing costs are going to go up. So that is going to be one drawback, I believe, from inflation for us.
right. So you've got the manufactured housing parks. You've got the self storage parks. You've got your funds. Are the funds are they segregated between the assets, or is it those are the two assets, and wherever you find an asset, that's where you
That's
deploy?
right. That's
Okay.
right. So our investors are going to be diversified across both asset classes and across various geographies throughout the country. So there is a good amount of diversification there because of that.
Got it. And you said Fund One was 10 million. Did that go full cycle? You returned everything back to the investors, or?
We actually have one last property that's under contract that's scheduled to close next month. And when that occurs, I'm proud to say it will be a complete full cycle.
Oh, that's great.
Yeah,
Congrats. And
thank
do
you.
you find that most of your investors, once they've received their capital back, they look to reinvest? Give me more kind of, yeah.
Absolutely. Most of our investors are Fund One, Fund Two investors who have reinvested and basically reinvested all of the distributions that we've given them in the first two funds right back in. And guess who else is included in that category? Me. I'm a large LP in all of our funds, and I continue to reinvest all of my distributions. And the reason I do it is, Darren, two reasons. Number one, I like to have a great alignment of interest with my partners, for on one hand, and on the other hand, I do it for selfish reasons because, quite frankly, I don't know where I'm going to get a better return and where I'm going to mitigate my risk better than what we're doing here.
No, that's so true. I love the synergy of sorts as you have success and because what I've kind of come to learn is that people, when you're trying to raise money, the first couple times are maybe more of a challenge, but as soon as you have success and you return that capital, people are like, hey, wait, when's the next deal? Kind of thing. And
Exactly. Exactly.
and
Once you build up an investor's trust over time. When you go and launch a new fund, there's not really many questions. They already know our level of integrity. They know our ability as operators and our ability to execute on the business plan.
no, that's great. Um, Let me ask you, we've talked about some of the markets that you guys look at. Are there any, KPIs that you look for? I mean, for the longest time, I mean, pre-COVID, it was always about jobs and population and laws and stuff. But COVID seems to have changed a little bit, that sense because of everybody doing like what we're doing, the Zoom and that. I don't know. Is that affected um, your view of things or changed at all, or is there some different things that you look for now when you look in a market?
Um, when I look at a geography, I don't think COVID has a material impact on us making that investment decision. I will say this: we actually outperformed during COVID. Our properties, especially during on our storage side, our occupancies actually rose, and the way that happened was that we actually built online portals where where storage tenants could move into our units without making face-to-face contact with managers. We also had online portals for our manufactured housing and our storage tenants to pay their rent directly. So by being set up for COVID, we were able to actually outperform. Now, in terms of our investment decision, I don't think COVID has had an impact on that. It certainly hasn't had an impact on our geography, if that's the question.
Yeah, I just think if there's anything that's affected, but it sounds like it's pretty much hasn't been an issue for you guys. That's great.
No, knock on wood.
Yeah,
We're not out of the woods yet. None of us are. We
yeah.
don't want to rest on our laurels, but up to this point, we haven't been materially negatively affected from COVID. So
Got it. Hey, man, if we could, I'd like to shift gears here for a second. By
yeah.
day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. First, we look to see, can we avoid the risk? If that's not a possibility, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is, a risk transfer vehicle. And I like to ask my guests if they can look at their own situation. It could be their clients, their investors, the market, tenants, however you want to define it. But if you can take a look at your situation and identify what you consider to be the biggest risk, and for clarification, I'm not looking for an insurance related answer necessarily, but if you're willing, I'd like to ask you, Matt Ricciardella, what is the biggest risk?
Well, I think it's a great question, obviously. And I think there's a lot of answers to that question. But I've thought about this, obviously, in depth. I think for me personally, and what we do, by far the largest risk is overpaying for an asset. Um, you could take a good investment and make it a poor one by paying the wrong price. Vice versa, you could take a mediocre investment and make it a wonderful one by paying the right price. So we focus diligently on not overpaying. And the way we do that, there's a term, actually, I think Charlie Munger had this term, which is Warren Buffett's partner. And he said that risk is inextricably bound up in the price that you pay for an asset. And I think that rings true for me in a major way. The way we mitigate that risk, to answer the other part of your question, Darren, is by and large, we don't compete with the rest of the buyer pool that's out there. The way we do that is we buy most of our properties off market. So we create a bond and a relationship with the seller where we're dealing direct with them without a broker. And that's how we put probably 80 to 90% of our deals together. Right now, as I mentioned, the two asset classes are white hot. Because of that, there's bidding wars, there's auctions. You have to compete in those auctions and you offer the highest price and you win. But question I have is, are you really a winner or are you a loser? I mean, you paid more than everyone else out there. So we like to focus on finding our deals without competing. And I think that's how we lay off the risks, as you would use the term in the insurance world, or we mitigate our risk to a large extent.
No, makes a lot of sense. Matt, where can the listeners go if they'd like to learn more or connect with you?
Yeah, so if you want to learn more about making an investment into the third offering, yeah, you could visit our website at www.crystalviewcapital.com. Or you can email us at invest@crystalviewcapital.com, or you could email me directly at mattar@crystalviewcapital.com.
Great. Hey, Matt, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and hope we can do it again soon.
It's been my pleasure. Thanks for having me, Darren. Let's do it again.
All right.
All right.
For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.